Hello everyone, you are welcome to today's class. It's nice to be here once again. I'm very glad being here, and it's a pleasure talking to you. This class is meant to do what? To educate us on how to plan our finances. Anyway, in this part of the topic that I'm treating, which is on financial leverage and theory of capital structure, in some of the videos on this particular topic, on financial leverage and theory of capital structure, I made an attempt at define what we mean by what leverage or gearing. When I say leverage, we're talking about gearing. So where I said that if a company has an element of debt, in its capital structure, the company is said to be what? To be geared. To now depend on the level of the debt, that will now make us to classify whether the company is highly geared or low geared. Or if at all, if the company has an element of debt in its capital structure, the company is said to be a geared company. Having said that, I said that a high level gearing, a high level of debt creates financial risk. So I said that financial risk is the increased risk of equity holders due to financial gearing. The introduction of a debt finance in the capital structure of the company makes the company to be what? To be geared. So the more the debt, the more the risk faced by the what? By the holders of equity. Meaning that the equity holders will suffer a lot if the company is not making enough profit to do what? To cater for the interest of the debenture holders, of the debt holders. Why? Because the debt holders will be settled first before talking about the equity holders. But that, therefore, if a company is highly geared, it's going to create a financial risk for the debt, for the equity holders of the company. So that is why I now say a high level of debt creates financial risk. And financial risk is the increased risk of equity holders due to financial gearing. So therefore, when a company introduces fixed interest debt into its capital structure, it increases its financial risk. Which I tend to explain then as well, to partly because it's increased to financial risk, the company is increased to financial risk, partly because the interest must be paid whatever happened to earnings. The company must pay the interest of the debt holders whatever happens to the earnings. Meaning that whether the company makes enough earnings or not, it must settle the debenture holders, debt holders, which in turn is creating a financial risk for the equity holders. And that, therefore, and I want to do what? Examine, to now lead us to the question that how do we now combine these source of finance in order to do what? In order for the company to make profit in order to maximize the shareholders' wealth. Because like I said in one of the previous videos, that the debt also has advantages in the capital structure of the company. One of the advantages is that it is tax allowed expenses. That is, the interest paid on the debt is a tax allowable expense. So it leads to tax savings. Having said that, we also examine the various degrees of financial gearing. If you have not, you just listen to this video for the first time, listen to this topic for the first time, watching this video for the first time, just scroll down. You're going to see, click on we are on my home page now. Click on the videos on my home page, click on the videos beside the home. It will show you all the videos I have there. So just scroll down. So for you to do to see, we have discussed the various degrees of financial gearing. Okay, so today, now it will now lead us to the question of how do we now structure, how do we now combine, how do we now put together all these sources of finance in order to to achieve the aim of maximizing the shareholders' wealth. This now leads us to what we call the theories of capital structure. So in financial management, capital structure theory refers to a systematic approach to financing business activities through combination of equity and liabilities. So therefore, capital structure is a way of means of putting things together, to have the structure, putting things together to have a balance. Okay, so in FM, financial management, capital structure theory refers to a systematic approach to financing business activities through combination of equities and liability. So what we are trying to examine here is how do we now combine equities and liability in such a way that it's going to do at the end of the day, it's going to do it will not create the financial risk for the equity holders. And at the end of the day, you are going to maximize the wealth of the equity holders. So that's what we are trying to do, examine under capital structure. So we have different theories, school of thought that postulate how to do this, how to have this, how to do to still achieve our aim. So it employs the relationship between debt financing, equity financing, and the market value of the firm. The theories are, stand here, so I'm going to capture it. Okay. So the theories are: 1, traditional theory. Traditional theory. We have different theories under the capital structure. We have the traditional theory. We have the net income approach. We have the M&M approach. M&M means Modigliani and Miller approach. So we are going to do examine this, but majorly we're going to examine traditional approach and the M&M approach, which is Modigliani and Miller approach. So the traditional theory states that debt capital is cheaper than equity. That debt capital is cheaper than equity. Debt means that's debenture, debt, any form of debt, borrowing, but majorly we're talking about debenture here, but can be any form of debt. Is cheaper than equity, and that a company can increase its value by borrowing up to a reasonable limit called optimal level of gearing. That is to say, what traditional theory is trying to tell us is that debt capital is cheaper than equity, and that a company can increase its value by borrowing up to a point, up to a reasonable limit called optimal level of gearing. This theory postulates that we should use debt as a form of what in our capital structure. We use debt to form part of our capital structure. Why? Because it is what cheaper than equity. Why did they say it's cheaper? Because the cost incurred for issuing a debt capital is far lower than the cost incurred in issuing what equity finance. For example, the issue cost, you have to do a lot of rigorous process. Issue cost. Why debt financing can just approach a bank and get loan? We have venture holders who can just it's easy to do to get than equity. Every you have to go through issuing costs, issuing houses and stuff like that before you can raise funds through equity. And also, under debt finance, the interest element on the debt is a tax allowable expense. So these are some of the reasons why the traditional theory states that debt capital is cheaper than equity, and that it can borrow up to a point at a reasonable limit called optimal level of gearing. And this to say there's a level in which you can borrow up to that's going to give you that's going to maximize the level of the return to ordinary shareholders as well. So any debt capital beyond the optimal level of gearing will create unnecessary leverage and evaluation of the company. So after you have now reached this optimal level, you've now crossed above the optimal level, you are going to do what? You are going to create unnecessary leverage and evaluation of the company. So the value of the company will be maximized where the cost of capital is probably the cost of capital is is at the minimum. So that will now be the optimal level. That will be the optimal level. So that is what traditional theory is saying here. That debt capital is cheaper than equity, and also there's an optimal level of gearing. At that point, you should not tend to do increase a little your debt finance in the company is going to create unnecessary leverage and also the valuation of the company. I would say that there are some assumptions made by the traditional theory. There are some basic assumptions made by the traditional theory. So, some of these assumptions made by the traditional theory is that the cost of debt will remain constant until a point is reached when it will start to rise. And that is exactly what this one is saying as an optimal level. Okay, let me give it to us. Let me just quickly write the assumptions of the traditional theory. You can see this. So let's look at the assumptions of the traditional theory. Let me have some water here so that it can be cleaned properly. So here we have some of the assumptions of the traditional theory. Assumptions. So one assumption is that the cost of debt we point is reached when the work, looking at because of counter work. And the level of gearing increases. Okay. Some of the assumptions of traditional theory is one, the cost of debt will remain constant until a point is reached when it will start to rise. Secondly, the weighted average cost of capital, which is WACC, will fall immediately an external source of finance is introduced into the company's capital structure. The WACC will be rising thereafter as the level of gearing increases. So, the third assumptions of the traditional theory is that the market value of the company and its market price per share will be maximized where WACC is at the lowest point. So I have made mention of that point. That's when I was discussing this traditional theory, which is the optimal level. So the optimal level is what they're talking about here in point 3 in assumption 3, where it's stated that the market value of the company and its market price per share will be maximized where WACC is at the lowest point. This is what they're talking about is something as well as the cost of capital. So therefore, that would be what the optimal level. Optimal level of debt in the capital structure. So by this, therefore, the traditional theory is saying that we should Well, we can use debt finance up to a point. And after that point, the company is going to do what? Be carrying unnecessary what? Unnecessary leverage, and which will in turn leads to what? Leads to devaluation of the company. So that is what? That is the traditional theory of what? Of under the theories of tradition of what? Of capital structure. So another major theory which I'm going to look at is what? Is the M&M Theory, which is what? The Modigliani and what? And Miller theory of what? Of capital structure. So those are the major these are the major two theories in what? In capital structure that I want to make a reference to. So watch out for the second theory of what? Of the traditional approach of what? Of M&M theory of capital structure in the next video. So at this point, thank you for watching, and see me in the next video where I'm going to treat the M&M theory of capital structure.